All right, imagine you wake up Wednesday morning, grab your coffee, and see this. Silver's just spiked nearly 9% in a single trading day, after crashing 41% in barely a week. That's no normal bounce. That's something snapping back under pressure. What just happened to silver isn't a blip. It's the kind of move that shapes entire quarters in precious metals trading. When you get swings like that, it isn't only traders who should pay attention. It's anyone who wants to understand how markets behave when stress hits. Because moves this violent leave fingerprints you can use long after this week's headlines are gone. So, stay with me because I'm going to break down exactly why silver exploded higher, what history says happens next, and how you can recognize these same signals before the crowd sees them. Before I explain what caused this whiplash, let's hit the foundations. Most people think a spike means momentum has returned. In reality, it usually means positioning just slammed into a wall. Think of the market like a crowded elevator. Too many people smash the sell button at once. The floor gives way, and everyone panics. Then suddenly, someone inside realizes they've dropped their wallet halfway down the shaft. They scramble back in. Boom, the bounce. Silver's 8.6% surge wasn't optimism. It was reflex. Forced shorts covering, algorithms flipping direction, bargain hunters trying to grab what's left. When you understand that, you stop asking, why did silver rise? And start asking, who just got trapped? Because that's the real education moment here. If this is making sense so far, drop a comment and let me know. Are you watching silver right now? Or is this your first time seeing this kind of volatility? Your answer actually matters because it tells me how deep to go on the next part. Now here's what's actually happening. Since January 29th, silver went from 122 all the way down to $71 by February 2's, a 41% collapse in roughly 72 hours. That's the definition of a market falling faster than rational minds can compute. When that kind of vertical descent hits, brokers start calling in margins. Traders are forced to liquidate. Liquidity dries up. Then, when those positions get washed out, the next uptick triggers a wave of buy-to-cover orders. That reflex short covering creates these violent rebounds that look healthy, but really, they're mechanical, like the recoil of a spring that's been crushed too fast. Here's the sequence that just played out. First, you had leveraged longs from the January rally sitting on massive paper profits. They're riding high, confident, not expecting the rug pull. Then something shifts. Maybe a big fund decides to take profits. Maybe margin requirements get raised. Doesn't really matter what lights the fuse. What matters is the cascade that follows. Once price drops 5%, the first wave of stop losses hit. That selling pushes it down another 3%, which triggers the next layer of stops. Now you're down 10% and margin calls start coming in. Traders who were leveraged 4-to-1 or 5-to-1 suddenly have to post more cash or liquidate. Most can't post the cash, so they sell. That pushes price down another 15%. Now you're in free fall. The algorithms see the momentum and pile on. The velocity accelerates. By the time you hit that $71 low, you've got pure capitulation. People selling at any price just to stop the bleeding. But here's what happens next, and this is where Wednesday's action comes in. Once you flush out that much leverage positioning that fast, you create a vacuum. There's nobody left to sell. The weak hands are gone. Now, any buying pressure, even modest buying pressure, meets almost no resistance. A few value buyers step in around $75,000. Maybe some institutional traders see the RSI oversold and take a swing. Shorts who wrote it down start taking profits. And just like that, you get a snapback. Not because sentiment changed, not because fundamentals improved, but because the market ran out of forced sellers and short covering created mechanical buying pressure. That 8.6% spike, that's the sound of trapped shorts scrambling for the exit. According to bar charts data, these rebounds almost never mark the end of the move. They're punctuation, not resolution. You get wide range days, massive candles on the chart, because both sides are still fighting for control. Late buyers from the January rally are terrified of another flush. Longer-term bulls are waiting below, around that $75 to $80 zone. It's trench warfare. And Wednesday matters because it's the day that reveals whether that surge was capitulation relief or merely the eye of the storm. But here's the part that should make you nervous. When everyone's trying to trade the same emotion, fear turning into hope, you get phantom stability. Price holds mysteriously steady for a few hours. Analysts call a bottom. Headlines say the worst is over. And then, bang, the next wave of selling starts. Recognizing that pattern is everything. You'll know it by the size of the candles, the speed of reversals, and whether volume explodes without follow-through. If you learn to read that rhythm, you'll spot exhaustion before the headlines catch up. You'll see when relief is real and when it's just a pause before the next leg down. And this isn't new. Every time silver's had a parabolic run, it's followed the same three-act drama. Go back to 2011. Silver sprinted from the mid-20s to almost $50 in months, then imploded. It staged a monster rebound that tricked countless traders into thinking the trend was resuming. Then it spent years grinding sideways, never getting back to that high. Same basic script. Same pattern in 1980. Volatility so high that exchanges literally change margin rules midweek to slow the bleeding. Hunt Brothers tried to corner the market, push silver to $50, then it collapsed. The bounce after that initial crash, it fooled a lot of people. Even in 2020's pandemic chaos, silver doubled off the lows, stumbled hard, and only stabilized after weeks of violent swings that shook out everyone who wasn't anchored to a long-term thesis. Zoom out, and you see this isn't random at all. It's human behavior repeating through different headlines. Fear, greed, relief, disbelief. It's the market's heartbeat, skipping precisely where overconfidence builds. Every single time, you see the same cycle. Parabolic rise driven by momentum and FOMO. Sharp collapse that catches leveraged traders off guard. One or two violent relief rallies that look like reversals but aren't. Then a long grinding period where the market digests the excess and rebuilds a base. We're probably somewhere in that middle phase right now. The question is whether this bounce has legs or whether it's just another bear market rally that fades in a few sessions. Now, let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this time be different? Sure. Maybe industrial demand for silver and solar panels and electronics is strong enough to justify a faster recovery. Maybe big funds rotated back in after missing the last run and they're building positions at these levels. Maybe geopolitical tensions or inflation fears are driving safe haven demand in ways that change the normal pattern. Or maybe you're hearing whispers about manipulation, the idea that someone engineered the collapse just to reload cheap before the next leg higher. I'm not ruling anything out. Markets are complex. There are always multiple forces at work. But here's the thing. Chasing invisible villains won't help your portfolio. Debating whether this was manipulation or organic deleveraging doesn't change what you do next. Focus on what you can control, which is recognizing where psychology turns into opportunity and where it turns into a trap. You can't fix the system. You can, however, read its tells. And right now, the tells say we're still in high volatility mode where emotion dominates and fundamentals take a back seat. There are probably three kinds of people watching this right now. First, the traders who rode the rally, missed the exit, and are now praying this bounce continues. If that's you, I'm going to be honest. Protect capital before pride. Hope is not a hedge. If you're sitting on unrealized losses and waiting for silver to come back and rescue your position, set a hard stop. Decide right now what level you're willing to lose to and stick to it. Don't let a manageable loss turn into a catastrophic one because you can't admit you were wrong about the timing. Volatility like this can grind you down psychologically. It's better to take a small loss, clear your head, and wait for a cleaner setup than to white-knuckle a position that's working against you. Your future self will thank you. Second, the cautious buyers who have been waiting for the dip and are wondering if this is it. For you, patience is armor. Wide volatility means better entry points ahead. Don't feel like you have to catch the exact bottom. You won't. Nobody does. Instead, wait for signs of stabilization, consecutive days where price holds support, volume starts to normalize, and the wild swings narrow. If silver can hold above $80 for a week without retesting the lows, that's a better signal than trying to pick the bottom at 71 and watching it drop to 65. You've got time. Let the dust settle. Let the market prove it wants to go higher before you commit capital. Third, the long-term holders who don't trade every heartbeat, they're watching because they sense this volatility says something bigger about trust in fiat currencies and inflation expectations. You've got the right idea. Focus on fundamentals, not just flash crashes. If your thesis is that silver is undervalued relative to gold, or that industrial demand is going to outstrip supply over the next decade, then short-term price swings are just noise. Dollar cost average if you want to add exposure. Don't try to time it perfectly. And remember, volatility is the price you pay for asymmetric upside. If silver was calm and predictable, the opportunity wouldn't exist. And across all three groups, here's the universal rule. Volatility is the tuition you pay for clarity. The longer you watch without flinching, the faster you learn the rhythm. Every wild swing teaches you something about how markets move, where support and resistance really are, and what your own risk tolerance actually looks like. Don't waste the lesson. So, here's what I want you to answer in the comments. Which group are you in right now? Are you holding a position and managing risk? Are you on the sidelines waiting for a cleaner entry? Or are you a long-term stacker who's just watching the show? Tell me, because I read every comment and I want to know what you're thinking. Here's where I stand. I'm not calling a bottom. I'm calling a battleground. First, I'm watching whether silver can hold above $80 through midweek volume. If it closes above that level 3 days in a row, that tells me the selling pressure is exhausted and buyers are stepping in with conviction. If it can't hold, if we see another retest of 75 or lower, then we're probably not done with the downside yet. Second, I'm watching open interest in the futures market. If open interest keeps dropping, that means forced liquidation isn't finished. Traders are still closing positions, which means more volatility ahead. If open interest stabilizes or starts to climb, that's a sign new money is entering and the market's finding its footing. Third, I'm watching the gold to silver ratio. When that spread narrows under stress, it signals real conviction, returning to metals broadly. If gold is holding steady while silver bounces, that's a good sign. If both are dropping, that's a different story. This spike wasn't random, it was structural, mechanical, inevitable once leverage unwound. The fundamentals behind silver, industrial demand, tightening supply, its role as both a monetary metal and an industrial commodity. Those fundamentals remain real, but sentiment still needs to heal, confidence needs to rebuild. And that takes time. If history rhymes, the next few sessions will tell us whether we're witnessing the rebirth of a trend or just another echo before gravity resumes. I'm not a financial advisor. This is not financial advice. Do your own research. But if you made it this far, you're the kind of person who thinks critically and doesn't just follow the herd. That mentality will serve you well. Markets punish impatience faster than they reward daring. What matters isn't predicting the next candle. It's learning to recognize the pattern that creates it. If this breakdown helped you see the structure behind the chaos, hit that subscribe button and share this with someone who's trying to make sense of what's happening right now. You're ahead of the curve just by asking the right questions. Stay sharp out there.